we've seen such a pronounced rebound in the U.S. equity markets, in particular since Liberation Day. And at those valuations, investors have to ask the question, are the risks ahead so balanced to the upside? And I'd argue that the risks are balanced, but perhaps not so optimistic. And so if you're looking at that valuation profile, your opportunity set might be a little bit different. From our perspective, we're taking gains in equity, deploying them in credit, and we can talk a little bit about what that looks like. But we're also looking at an equity market profile in the U.S. that might benefit from some private markets exposure, especially in the small cap space, where we see more of an engine sort of the real economy. Really, and considering also the not just structural ideas I've mentioned, but also the cyclical reality that other parts of the world are cutting rates faster than we are, playing into industrial and financial sectors in those other countries.
You mentioned that you live on EcoGo. I've been looking at INGO, which is the Bloomberg Index browser. So for the last, 5 or 10 years, maybe 15, nobody wants to talk to the fixed income person at the cocktail party, right? Because there's no return. And now it's amazing. I mean, you're looking at massive returns. Year-to-date returns for Treasuries, 7%. Plus, you get to clip the coupon.
It's funny. For so long, the bond guys were thought of as pessimistic, and they're earning no yield anyway. But now they're kind of cool. And I do want to talk a little bit more about private credit. I actually caught up with the CEO of JP Morgan Asset Management earlier this week. We were talking about high yield versus private credit. His view is that private credit looks a little bit frothy right now. I believe we have the specific quote that there's a lot of money and investors chasing finite opportunities in the private credit market. You also have liquidity trade-offs. You take those two things in combination, and on a marginal basis, I would put my marginal dollar in public high yield rather than private credit. I thought that was really interesting because private credit has been so hot. It sounds like you see a place for it in a portfolio, but when you stack up high yield versus private credit, how does that risk reward look to you right now?
The answer to your question, which is such a smart question, lies in actually an economic reality, which is that corporate profits are so strong. We are likely to see them move lower over the coming quarters, but we're starting from an economic reality where companies have raised an enormous amount of cash and been really smart with their capital stack. That includes in public high yield issuance. And so I agree with a bullish position on public high yield. Valuations are high, spreads are tight, but if you're looking at a 2 to 3 year buy and hold, grab a couple of high quality, high yield issuers, and that's a really interesting opportunity. I'm not worried about defaults on that time horizon for high quality. But the same is true in private credit. This is an asset class that, just like in public credit, has a wide variety of operators, some higher quality than others. And if we look at an environment where you can harvest meaningful all-in yield, and that's really what you're looking at, is avoiding defaults, capturing the yield. In this economic environment, if you can work with a conservative, very quality-focused private credit borrower, that's another couple-year opportunity that I think is really interesting in this environment, and probably more interesting now if you think that rates are going to be moving lower as we move forward in the year.
Yeah, and spreads may be tight, but that means yields are high as well. So you just kind of have to choose which to focus on. Lauren, great to see you. Really enjoyed speaking with you as always. That is Lauren Goodwin of New York Life Investments. Meanwhile, back in this equity market, we are on record watch. Let's dissect this rally right now. The number you need to keep an eye on is 6144 for the S&P 500. You take a look at where we are right now, 6112. So we are very close, and good news. Breadth is very strong today. You have more than 400 names in the green right now, fewer than 100 in the red. And you take a look at what's leading right now at this moment. Good news, it's big tech. Microsoft, Nvidia, Meta, really leading this rally. You do have JP Morgan fighting to get into the top three. We'll see how that shakes out. On the downside, you do have Apple. That's not surprising to see in 2025. Equinix and Tesla as well, but still not necessarily dragging us down when you think about who they're competing with. Let's take a look at the sector level, and it will broadly reflect what we're seeing on the individual movers as well. Up at the top, you have materials, utility, energy. The list goes on. Tech down here only with a 0.2% gain for the sector overall, but certainly more green than red. Your sole loser today, Matt Miller, is real estate, off by about 0.7%.
Is that a Mamdani thing, you think?
I don't think so. I think that would be a lot to extrapolate.
Coming up, NVIDIA, Micron, and other big tech stocks soar. We are looking at I guess Micron is swinging back and forth between gains and losses, but NVIDIA now worth $3.77 trillion, one of only 3 companies in the world worth more than $3 trillion. We're going to discuss what's going on at the chip makers with Bloomberg Intelligence global head of tech research. This is Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And this morning, we have a tech theme. Let's start with Apple getting cut over at JP Morgan, slashing the company's price target to $230 from $240. Analysts over there see iPhone 17 demand being impacted by macro uncertainty. Shares down a little bit this morning. Meanwhile, Morgan Stanley is raising its price target for Microsoft to $482, or rather from $482 to $530. Very specific. The analyst cites upside from the company company's Azure cloud service. And finally, Baird, Wedbush, and Stifel are among the firms that are raising their price target on Micron. The chipmaker did come out with an upbeat earnings forecast, but it wasn't quite enough to impress Wall Street. You can see shares kind of trying to decide what to do today, Matt.
Yeah, absolutely. And we're going to talk about what Wall Street does with tech today and this year. We got the Micron story, which is kind of did she or didn't she, right? Because as you said, a lot of people were hoping for more growth in the outlook. Mandeep Singh joins us right now. He's the global head of tech research for Bloomberg Intelligence. And Mandeep, before we get to NVIDIA, and it's almost all I care about right now, let's talk a little bit about high bandwidth memory chips.
Yeah.
It's just as boring as it was when I started covering DRAM 25
really
years ago.
Really selling it.
Yeah, no, I mean, I can't get hyped up about this, but Ed Ludlow from Bloomberg Tech says I should. Do you agree?
I think so. Given the print last night, 15% sequential growth for this quarter and guiding for 15% sequential growth, mostly driven by high bandwidth memory, which is a $6 billion business now that didn't exist last year. So when people talk about AI data centers as a market, and it's about $250 billion right now, if you look at NVIDIA's revenue, expected to grow to $500 billion, memory, HBM, is one of the major components of that data center expansion, and that's what they are showing in their results, is that $6 billion revenue will likely double next year. I mean, I think you will see positive revisions.
Can I just, before we had 20 megapixel cameras on our phones, right? Katie, we used to buy these digital cameras.
Tell me about these old
And you would put these little memory cards in there that you'd buy at like the drugstore, the newsstand. There used to be newsstands.
Right.
And it didn't matter whether it was from SanDisk or Micron or SB Hynix. I didn't care. It all works the same. Is that true about HBM as well?
So you're absolutely right. HBM is a duopoly between Micron and SK Hynix. But the thing I would like to point out is the market is still supply constrained. So look at the cost of a server. It's gone from around $10,000 to $270,000 with AI and NVIDIA chips. The cost of memory in the traditional server was like $4,000. With HBM, it's about $12,000 to $15,000. So it's 3x. The cost of, like NVIDIA obviously has had the most kind of use in terms of the ASP increase, but HBM ASPs has also gone up 300%. And that's where this is a secular trend. Look, memory cycle will have its peaks and troughs. Typically, these are 7 to 8 quarters, but I expect this to continue for another 3-4 quarters in terms of positive revisions.
I am not going to ask you about an acronym right now. I want to zoom out a little bit and situate this conversation in the context of what's going on the geopolitical landscape, because we talk about trade tensions all the time when it comes to NVIDIA. It feels like that conversation isn't quite as loud when it comes to some of the other chip makers. Micron comes to mind. Do you think about what NVIDIA is dealing with? Are some of those issues idiosyncratic to NVIDIA, or are they industry-wide as well?
They are industry-wide, but the thing about AI servers and AI gear right now is it's supply constrained. Everybody wants it. And the more supply constrained it is, it gets reflected in the ASP growth of these companies. So the reason why NVIDIA's gross margins keep growing, at least they have so far, is because the market is supply constrained. To Matt's point about memory kind of being a commodity, yes, it will eventually be a commodity, but for now, HBM doesn't look like a commodity market, and that's why the pricing keeps growing.
All right, Mandeep, great to speak with you. Great to see you. That is Mandeep Singh. He is global head of tech research over at Bloomberg Intelligence. Now, speaking of trade tensions coming up, Nike investors hoping to get clarity about the delayed launch of its partnership with Kim Kardashian's Skims. Also, maybe curious about the supply chain as well. We'll break down what to expect in the earnings report up next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a look at what stocks are doing right now. Just about 20 minutes into the session, we're looking at S&P 6108. If you care about a new all-time world record high, it's 6144 on a closing basis, 6147 on an intraday basis, and we may get there today. We may not. We still have one more trading day this week, though. NASDAQ, really little change, but it had its gains. As we mentioned, NVIDIA hit an all-time high yesterday. NVIDIA itself currently down, but only 0.1%, so now it's worth less than $3.8 trillion, but I believe still more than Microsoft and more than Apple. Those are the $3 trillion companies. Micron falling as well. So we're losing some momentum with these companies falling. Shell is up after saying it is not in talks and does not basically want to buy BP, as had been reported. You have Walgreens, Boots Alliance, and Nike both gaining, but not doing a lot on earnings news. Katie, let's focus in on Nike.
Yeah, Nike coming up after the bell today, and those earnings are expected to move shares more than 7% in either direction. Bloomberg Intelligence senior retail analyst Poonam Goyal says that the company's turnaround could be at a turning point. She joins us now. So Poonam, this turnaround, let's talk about it a little bit, because Nike has seen 3 straight years of losses. It's down another 17% on a total return basis in 2025. Investors have been waiting for quite a long time here.
Yeah, you're absolutely right. The story for Nike has been very, very, sad, because you've seen them essentially lose $5 billion in top line over the last 2 years. Their shares have crumbled, and it's all because they have inventory that they can't sell. So what we're looking for today is where their inventory stands. Their inventory was down only 2% at the end of their last fiscal quarter, yet sales were down double digits. We need inventory to be down more, and that's what we're looking for today. But also the newness, right? So Nike has to reconnect with its shoppers. It has to bring more newness into the pipeline, and it's working on that. The question is, are we at the bottom today, and will we move up from here? And I think the inventory number will help us decide that in a meaningful way.
Nike is going to, I see on Instagram, Poonam, it's going to drop on Friday the Nike W Air Max Phenomena SWDC. This is like a sneaker, but also a loafer.
Ooh, a snowfer.
And it's horrendous, honestly. Does anyone expect this to sell? Who at the company made this decision?
Look, I think, they're trying. These drops are in limited quantity, right? You have to remember, when you're looking at these drops, they're not making millions of units. They are select quantity. It's for someone who wants to be different, who wants the latest fashion, the latest style. Some drops are going to go, to a far extreme, and some are going to be very popular. This may be the far extreme one, but it just shows that they're trying, right? They're trying, they're testing. And from what we know and from what we see, most of their drops have been very successful, especially the drops that they've had with the Kobe shoes. So I do think that they're making strides in what they're doing for the newness, but they have a lot of old stuff that they still need to get rid of.
Yeah, and I will note that those snowfers are $500, I believe.
I mean, they're part of the Serena Williams collection, and she is a legend.
She is.
Plus, she has really rich friends, so maybe they buy all of them.
We have 30 seconds left with you, Poonam. What is the latest on the Skims partnership?
Yeah, so it's been delayed till later this year, and they've said that it has nothing to do with supply chain. We think some may be due to supply chain. It just may be, them not being able to get the product at the right price at the right time. Because remember, there is now a high tariff on goods from China. So Skims is being made in China, which is a big question to ask today. Then we do think supply chain does have some part in it.
All right, Poonam, great to get your take. We will always be looking at your research. Our viewers can do that as well by typing BIGO on the Bloomberg terminal. Coming up in the next hour, Liz Ann Saunders says retail traders are buying the dip to power markets. We also have the CEO of PayPal joining us, Alex Chris, on his firm's stablecoin ambitions. This is Bloomberg Open Interest. We are 30 minutes into the trading day, now bouncing back up with the S&P 500 at 6116. NVIDIA is swinging higher again.
Swinging higher, 30 points away, as you've been saying, from a record high. We're pretty close, Matt Miller.
Yeah, I'm Matt Miller.
I'm Shonali Basak. Welcome back to Open Interest. It's a really interesting morning. Stocks shrugging off economic data, and it's game on for bank stocks because Wall Street firms could be set for a revival thanks to looser regulations and a delicate rise in deal making, Matt.
Crunch time. President Trump pressures Congress to quickly approve his big, beautiful tax bill by an ambitious July 4th deadline.
And the president turns up the pressure on Jerome Powell again. Mary Daly of the San Francisco Fed spoke earlier on Bloomberg.
The people in my district are cautiously optimistic overall, thinking that the economy is weathering some of the worst concerns and the uncertainties, but continuing to move along. So cautiously optimistic is where they are, and I think that reflects what's on top of their mind, less about what's happening in Washington and more about what's happening in their lived experience in their communities.
All right, so that was Mary Daly, and we'll continue to bring you obviously more on the Fed. But I want to focus in first off on bank stocks and financials. I'm sure Shonali won't disagree with that.
Won't stop you.
Liz Ann Saunders joins us. She's Chief Investment Strategist at Charles Schwab. And Liz Ann, it does seem like there's a perfect storm brewing for these stocks as deal making is expected to continue to chug along and pick up, as regulation is expected to continue lightening. Certainly there are no new regulations that these banks have to deal with. And the interest rate environment stays high. What do you think about financials?
Well, we actually, back in March, we neutralized all of our sector recommendations. So instead of having some with outperform ratings, some with underperform ratings, some with market perform or neutral ratings, we moved everything to neutral, simply because we've seen so much short-term sector volatility from a leadership perspective, in part driven by all of the policy uncertainty. Getting probably close to the point where we may want to put those sector recommendations on, but for now, everything is neutral. Where we think you want to focus on, and this could be part of the reason why financials are doing well, is screening for and investing based on factors. And we continue to have an up in quality focus on factors. So strength of balance sheet, high interest coverage, stability and profit margins. And on many of those quality-based factor metrics, financials broadly, not across the board, actually look fairly decent. So I think even absent having a sector view, you get a decent amount of quality embedded in many of the financials.
The most recent rally Matt and Katie were talking about a little earlier was very contingent on a lot of the big tech stocks just rebounding. And I'm really wondering, I want to pull up this chart for you, Liz Ann. Our producer Dan Curtis shared it this morning. You have economic surprises to the downside, yet the S&P now back near its record. And if you have economic surprises to the downside, perhaps traders are betting more and more, and you see it in Fed futures, betting on rate cuts, which makes me wonder and wanted to ask you, how contingent is this rally on successive rate cuts?
So I have a bit of a contrarian view about this. I actually think one of the reasons, not the reason, but one of the reasons maybe why the market has been so resilient is because the Fed remains in pause mode. So I'm not sure that the market's rally is a function of believing the Fed is going to imminently step in and cut rates. I think it's confidence in the Fed, at least at this point, sort of digging their heels in, suggesting that neither side of their dual mandate is suggestive of much easier policy here. So, and this is, by the way, in part because given the instability right now from a policy perspective, all of this uncertainty related to that, I'm not sure the elixir to what ails us, particularly as we saw in a lot of the data today that had a little bit of that stagflationary tinge to it with the downward revision to GDP, upward revision to PCE. I think that the Fed doesn't have, based on their dual mandate, the push to ease policy. And for now, I think the market views that to be the right call, not to mention that cutting rates here isn't really the elixir for what ails the backdrop right now from an uncertainty perspective.
Lizanne, you made the point that this rally has been powered by retail investors. They bought the dip, and it's paid off. I wonder if they're also moving back into a 60-40 portfolio, because when I type INGO on the Bloomberg and look at these fixed income returns, they're pretty darn good, and you get obviously this a little bit more stability, and you clip in coupons. And what do you think about bonds?
So it's not just semantics, Matt, but you mentioned retail investors. And I think of the investor class, I think that there is intrigue with the level of yields you can get that are relatively safe. And it's been our focus. You know, my colleague Kathy Jones, who's our fixed income strategist, has said stay up in quality, kind of hug the benchmark in terms of duration within treasuries. But my point about what has powered this rally is retail traders. That may seem like semantics, but I think there's a difference between maybe I would call them individual investors and retail traders, that cohort that was born out of the pandemic. And you see their fingerprints on this move up off the early April lows via areas like retail favorites, one of the Goldman Sachs baskets, or meme stocks, the non-profitable tech area. So I think we should distinguish between those two. I'm not sure the retail trader I'm talking about cares probably a lick, if not much, about what's happening on the fixed income side of things. They are very much in that, you know, buy the dip mentality that has served them well in the era they have become dominant, which is in this post-pandemic era. And I think that's where you're seeing the power. And data has shown that their weight within daily trading volume has leapfrogged the weight prior that had been at the top of areas like high frequency traders and quant and algo based institutions. So I think it's a cohort we have to continue to follow really closely because they have become much bigger power drivers of market moves.
What does that mean for the health of the market that you're seeing right now? If you had a rally that was so powered by people ready to buy meme stocks, ready to buy unprofitable companies, then how long could it last?
Well, that's, I think, one of the risks right now is that we're building complacency into the market structure. I still think the pain trade is probably higher because what the move up in the market has done a little bit later than when the retail trader stepped in to buy that intraday, you know, April 9th low, is it's pulled institutions along with it. So one of the other areas that you've seen outperform on the way up has been the most shorted stocks. And that's ostensibly the institutions have been forced to cover. But if you look at positioning among the broad sort of cohort of institutions, I would argue they moved from being in a pretty risk-off structure in the early part of April to maybe something more in the neutral to slightly risk-on. They haven't gone hog wild to the risk-on side of the spectrum, which is part of the reason why the pain trade may still be higher. But I think we also have a setup that's one of heightened complacency and therefore subject to some downside if we get some sort of negative catalyst. And if I wanted to put a finger on what that could be, the important upcoming deadline of July 9th, which was the 90-day extension of or the delay of the reciprocal tariffs that were announced on April 2nd.
Downside hedges are expensive. Lizanne, what do you think about that move?
Well, I think there's a way outside of maybe options-based hedging to provide some maybe lowercase h hedge in the portfolio by, again, staying up in quality. Now, factors like low volatility and stability and dividend yield admittedly don't tend to be the outperformers when you're in the up part of the cycle. That brings back in factors like momentum. But where you do get protected in relative terms, as we've seen throughout the course of this year, from a factor standpoint, are in factors like low volatility. So that's a way, without going to the extreme, into the options market, into expensive hedging options, to provide a little bit of that quality diversification within the equity portion of the portfolio.
Liz Ann Saunders of Charles Schwab, we thank you so very much for joining us this morning. Of course, just points away from a record high on that S&P 500. Let's look under the hood, though. Let's look at some single stocks moving this hour. Micron issuing an upbeat forecast helped by demand for AI equipment. It's now down, though, Matt, about 1.4%. But we have to remember Micron was actually one of the best performing stocks, the second best performing stocks in the S&P 500 over the past month. But Nvidia still on the rise.
Yeah, so it looks like investors taking some profits from Micron, which is, to be fair, a much smaller company than Nvidia. Back on the rise. It had a real swing in the past 20 minutes from negative to a gain of almost 1%, which for a $3.8 trillion stock is meaningful.
Yeah, absolutely. Almost 1% higher, helping power the market rallying back up to what might be another record. Now, coming up next, we're going to talk to the CEO of PayPal because college athletes are about to get paid directly on the heels of an NIL takeoff. He's going to talk about how PayPal is stepping in to power a historic shift in college sports. This is Bloomberg Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. Iran's supreme leader, Ayatollah Ali Khamenei, is claiming victory in the war with Israel, saying U.S. intervention achieved nothing. Khamenei warned that Iran could repeat its attack on U.S. bases if any aggression occurs. His comments come amid conflicting assessments about the effectiveness of those U.S. strikes. Consumer products giant Mars is facing headwinds in its bid to acquire the competitor Kellanova. The European Union has opened an in-depth investigation into Mars's $36 billion bid for the maker of Pringles chips, Rice Krispies, and Cheez-Its. Meanwhile, the U.S. Federal Trade Commission has approved the takeover, finding that the deal does not meet the standard for an anti-competitive merger. And the Federal Reserve relaxed plans it is going to relax a key rule which would reduce capital requirements for big banks. Shonali is the expert on this. This allows the banks to hold more treasuries and act as intermediaries in the $29 trillion market. Bloomberg reported on the potential relaxing of the rule last week. Is this the SLR thing?
Sure is.
Yeah.
We will talk much more about that soon in this hour. But for now, we're going to switch gears. We're going to go to another financial company that's also dovetailing with the world of sports. It's a new era in particular for college sports. A federal judge has officially cleared the way for schools to directly share athletic department revenue with student athletes for the first time. And so today, PayPal announced partnerships with schools across the Big Ten and Big 12 to distribute payments to student athletes. Joining us now, PayPal President and CEO Alex Chriss. And it's interesting, you have been saying since you got the job that innovation was going to be a big part of it. When you bring on a whole new host of students to the platform, how does this help PayPal grow?
Well, it's great to be here today. And look, the reason this is such an exciting partnership is these student athletes are already our customers. There's 19 million college students in the United States. Over half are already using Venmo, and even more if you add PayPal on top of it. So over a year ago, we started talking to the Big 10, the Big 12, and we'll be working with all of the other conferences to figure out, okay, how will they actually distribute these funds when this ruling comes down? And so we're very excited to be the platform that they chose for the safety, the security, and the ubiquity that PayPal and Venmo bring to these college campuses. So it's an incredible partnership. It allows us to put dollars directly into college students' pockets in the wallets that they use every day. They're already using Venmo to be able to go out to lunch and split the bill with their friends, for their parents to be able to send them money, to be able to pay their rent, and soon to be able to pay their tuition. So we've been innovating. We're leveraging the technology that we have at PayPal to be able to make this partnership happen.
I mean, Venmo is everything, Alex. Just everything for the kids and for the adults. I mean, my friends who are 50 years old are using this for the same reason. It's just another level. And you've managed to avoid the pitfalls that Zelle has found itself in. How do you move forward in really monetizing, really taking advantage of that momentum?
Well, we do think we're building the financial application for the next generation. And, you know, it was very clear when I got here that Venmo was ubiquitous. It was the verb for how people moved money. But we needed some innovation. And so we started with ensuring that the money that came into a Venmo account, our users could be able to spend. So our Pay with Venmo card, which is a debit card, which is part of this partnership. So now on all of these college campuses, students will be able to have a branded debit card to be able to show their pride. Alumni will be able to get it as well and show their pride. So a debit card to be able to pay with their Venmo balances, Pay with Venmo button for e-commerce. And we're seeing tremendous growth through both of those. That's how we monetize. Being able to get, with $18 billion of funds that move into the Venmo ecosystem every month, we just need to enable our users to be able to spend in the wallet that they know and love.
What could you tell us about how fast Venmo can be growing in the future? You're announcing these new initiatives. You are saying right now how much these students mean to you and how much they could increase adoption on college campuses. But at the end of the day, what are growth figures that could show any signs of how these initiatives are taking off?
Well, look, our customer base continues to grow. Even though we are ubiquitous, our customer base continues to grow. And now we're starting to see the monetization levers kick in. So Pay with Venmo grew 50% last quarter. Our Venmo debit card grew 40%, and overall revenue grew over 20%. And so this is just starting to see our innovations kick in, and I think we're in the early days of this new trajectory.
Speaking of early days, I want to ask about PayPal Ads. I believe it's less than a year old right now. How is that investment benefiting your overall payments ecosystem? And why ads now?
Well, look, this is a part of our whole transformation of going from a payments company to a commerce company. This is our ability to leverage an end-to-end experience with our merchants. When I talk to our merchant partners, they obviously want to use us for payments, but they're really interested in getting in front of customers. They're really interested in knowing their customers better and being able to personalize the experience. We have that customer data. and our customers have opted in. They have been part of our customer ecosystem and said, yes, we trust PayPal with our data to be able to share that in a responsible way with merchants so that we can provide a really personalized experience. And so being the owner of a two-sided ecosystem, we have to take advantage of that. And PayPal Ads is a great example of what we're moving there. You've seen some of the announcements that we've come out. Even just last week, we announced our ability to have an ad that is actually shoppable. So now merchants can actually have an ad where the user can click and actually buy right through that ad. This is changing the game for commerce and connecting merchants and consumers in an unprecedented way.
Alex, while we're talking about young people, college campuses, they're very interested in not just crypto, but also stablecoin and what stablecoin can offer as a method of payment. Now, our colleagues at Bloomberg Intelligence point out that you were actually the first major mainstream financial company to launch a U.S. dollar-backed stablecoin almost 2 years ahead of the pack. And when you think about all the others that are trying to do this now, JP Morgan, maybe even Walmart, what are you seeing that other people might not be seeing when it comes to the potential for stablecoin to back the payments infrastructure of the country or even the world in the future?
Well, I love this question. We were doing stablecoin before stablecoin was cool. So we launched PYUSD over a year ago, and we're now, to answer your question, what I'd say is beyond the hype, we're actually putting real use cases into our customers' pockets. So whether you're on Venmo, whether you're on PayPal, whether you're a merchant, you can now convert some of your holdings into PYUSD and earn 4% rewards. So we're putting money back into our customers' hands. You can use crypto to be able to make purchases on any of our PayPal merchants through our PayPal wallets. And so we're actually creating real use cases for our customers beyond just the hype that's out there.
And how much are you seeing in terms of adoption of this stuff? Because we hear so much about it from, Kaylee Lines on Balance of Power talking about the Genius legislation, but I don't think that Shonali and I are using stable coins on a regular basis yet.
I'm still using the traditional way, dollar-to-dollar payment.
There you go.
Yeah, look, here's the reality. We were a big part of the Genius Act. We were helping shape that, so we're very excited about the future of stablecoin. The reality is the first use cases are most likely to be cross-border transactions, right? When you're moving money and you're paying large fees for cross-border transactions, that's an opportunity to have a fast, secure, and inexpensive mode of currency, and I think we will be the leaders there from a stablecoin perspective. Domestic payments right now, you know what? They work. And from a consumer standpoint, there isn't a real incentive to drive adoption, which is why we're starting to create things like rewards and starting to incentivize users. And we'll see where that leads to. But I think it's likely to be a longer road for stablecoin adoption domestically. And I think you'll see acceleration on cross-border transactions, and especially folks outside of the United States that want to hold US dollars. And it's just very difficult. Stablecoin opens up that opportunity.
Alex, congrats on the Big Ten announcement today. That is Alex Chriss, the CEO of PayPal. We're looking forward to talking to you again soon. Now, still ahead, we're going to talk more about financials because you're right, Matt. They are really catching some attention today. Jefferies, for example, the profit's actually slumping on weak deal making. So for all that excitement, we're going to talk about what all this means for the Wall Street bank earnings that are coming up in just a couple of weeks. That is in red on my calendar. We'll talk more about it in a minute. This is Bloomberg Open Interest.
All right, we are still quite a ways away, I guess 30 or 40 points away from a record high. And you can see from this move screen that the S&P has taken a move down, but we're still looking at 354 gainers, 147 losers. So the breadth is there. NVIDIA and Facebook, Broadcom leading the way, Apple and Equinix going down here. In terms of what we're seeing in the sectors right now, almost every sector is gaining. The only problem really is real estate, but consumer staples are down as well, Shonali, which I think is fairly interesting because then people aren't playing defense today.
Less than 20 points, 25 points away from that record high. But stick with us. We're going to talk about infrastructure next. We're going to bring in American Water's CEO. Stick with us. This is Bloomberg.
This week's heat wave was another strain facing the nation's water supply. In a recent op-ed in Newsweek, American Water CEO John Griffith outlined the harsh reality. The infrastructure for our drinking water and wastewater is crumbling, and John Griffith joins us now to talk about it. So, John, you know, this is one of those things that I've been hearing about for most of my life, that we need to really start to worry about water, that we can invest in water. And is that now going to become a reality? Are we starting to get to the tipping point, so to speak?
We are, Matt. There was a lot of federal capital invested in our water infrastructure and wastewater infrastructure back in the 1970s with the Clean Water Act and the Safe Drinking Water Act. since that time, municipalities really haven't had the opportunity to invest a ton of capital in the system. So there's a lot of deferred investment, a lot of deferred maintenance. There are increasing environmental regulations, as you might be aware, for water quality. So there's just a lot of investment that needs to be made. The American Society of Civil Engineers gives drinking water in our country a C- rating, and wastewater a D+ rating. So there's just a lot of capital that needs to be invested.
John, something that Matt and I talk to a lot of investors about on this show is the tax bill and the kind of strain that's not actually just on the nation's finances, but on state finances that could be exacerbated. Now, if states face a bigger cash crunch, then how troubled is their infrastructure investment spending at the end of the day?
Yeah, it just makes it harder and harder. The states have competing priorities, and really we operate and we see it at the municipal level as well. A lot of municipalities have debt, underfunded pensions, needs for capital other than water infrastructure, so they tend to just let it lag year by year.
What is the specific infrastructure that's really problematic? You're, I guess, not talking really about climate change, or we haven't gotten into the drought conversation yet, which right now, it's been raining every day for this year. But but what about the actual, network, the way we move water around?
Yep, and that's the business that we're in. So American Water is the largest wastewater utility in the country. We're in 14 states. We serve about a population of about 14 million people, in addition to 18 military installations. It's about water treatment and then transmission and delivery of treated water, and then also wastewater collection and treatment as well. That's really what we do. It's hard to dig up the ground, put new pipes in the ground. In our own network, we've got about 55,000 miles of pipe under the ground. Every year, we invest in about 450 miles. So it's just an incredibly slow turnover of the system. And frankly, we're fast. We're kind of market leading in that regard. It's expensive to dig it up and to put new pipe in. And that's what you see at the municipal level as well. And then on top of that, there are federal EPA PFAS regulations, lead and copper regulations that also require immense amounts of capital. Water supply is a separate but related issue. In most of our jurisdictions in the eastern half of America, there's good water supply and that can be managed. We've got operations in California and Hawaii as well. California, we're developing a desalination facility, which can be useful. Some states just have a difficult time capturing and retaining and storing rainwater and other sources of water. So that's where we start to see those kinds of constraints.
Now, John, something that's interesting, and I also want to say it's a really interesting year for you taking over as the CEO. The stock for American Water is starting to rebound from a 3-year-in-a-row decline for the stock price. And at the same time, despite all the kind of very capital-intensive projects you're talking about state by state, you're investing. You recently made an acquisition, and an analyst recently asked you, with the pressures you're seeing on different states and the infrastructure in them, are you willing to invest more? Are you willing to do more acquisitions to grow your network?
Yeah, we are. We invest organically and inorganically, or through acquisition. We'll be investing $40 to $42 billion over the next 10 years. About 10% of that will be acquisitions. The vast majority of it is just good old-fashioned infrastructure renewal. And water is a sector, when you think about it, there's just not a lot of opportunity for technology substitution, right? You got to, you got to treat the water, and you got to be able to deliver it. It's a pretty basic business in that regard. We really think it's a strong point for our sector, for water and wastewater, and for our company. We invest in a very growthy way. We talk about our rate base investment. Rate base is what we earn on as regulated utilities, growing that at 8 to 9% over on a year-by-year basis, on a CAGR basis over the long term, and earnings by 7 to 9% over the long term. And it really goes back to just those basic needs of system needs that are so underinvested today.
Hey, and what's your take on the regulation? I mean, if if there is a regulator holding prices down, that skews, obviously, the market. How much would water cost if that weren't the case? What's your take on that?
Yeah, the regulation at an EPA level, at a federal level, is necessary regulation, and it really goes to human health. This is water quality. So PFAS in the water, which are commonly known as forever chemicals, right from consumer products that end up in the water streams, lead and copper need to be worked on. So those are incremental costs.
But I was thinking more about the price, John, because if water, I mean, it's obviously a very valuable resource.
Yeah.
I mean, I pay a lot if I fill up the pool, but I don't pay that much if I'm just drinking it out of the tap and using it.
That's right.
So how much should I be paying for it?
Sure. Well, the water that we deliver, you're not paying for the water itself. So a utility like American Water, we have allocation rights. Let me say it differently. Outside of certain Western states, but by and large, we pull water out of the environment. We treat it. We deliver it. It goes back. We treat it again. It goes back into the environment. The cost that you're paying as a customer is really the infrastructure cost and the operating cost. It's the return on and the return of the capital that we invest.
John, very good luck.
So there's not a markup on the water per se, or even a cost of the water.
Well, we're watching the cost of all utilities very closely right now. John, we thank you so much for your time and for joining us today. That is John Griffith of American Water on his investment plans. Let's get a check on these markets now, because of course we are so close to that record high. I believe we are less than 20 points now, Matt, away from that S&P 500
Yeah,
record.
I'm not good at math, but 61.44 is the closing record. 61.47 is the intraday high. Obviously, it doesn't really make a huge difference, but it's a number that we're looking for, a milestone that we're watching closely. So, and I think a lot of investors are watching as well.
Yeah, absolutely. And the question is, how far can you break away from that? The bond market also still on a tear. We haven't been talking about it, but 426.
I have been talking. I've been looking at IN Go also. So not just WB Go for the treasuries, but IN Go will show you year-to-date returns on any of these indexes where we haven't seen returns for the last, 10 or 15 years.
60-40 is back, at least for now.
That's right.
So going to look at some single stocks moving this hour as well. I know you guys were talking about it a little earlier. Walgreens is higher after quarterly profit beat expectations. McCormick also higher. Its outlook is easing investor concerns.
A $20 billion spice company.
Spices are delicious. What can I say? I use all of them for everything I cook. Some people are too boring. Salt and pepper is not a lot.
But does it make a difference? Like, is there a difference between McCormick's cumin and the cumin, like, at Bowl and Basket?
You mean besides the price you pay? I loved Isabel Lee's comment a little earlier. The glass you pay for what it's stored in. This is why you go to the Indian store and buy it in bulk. Anyways, we are going to go on and move over to banking as well, because Jefferies is